Hi, good evening, everybody. And Stan, is my network strong? Like, can you hear me very clearly?
For now it's clear. Maybe when we now,
Right.
maybe me in the middle of the class we can now check. But for now it's clear and audible.
Just let me know if there are any changes. Text me on WhatsApp.
Okay.
All right, good evening, everybody, and welcome back to another class. All right. So, there are a few things I want to touch today. Few important things like the concept of engineered liquidity, one, setting alert on synthetics, the second one, then a brief on top trends, and just a little thing on trends and trends, currencies and synthetics. All right. Now remember that as at the third of last month, that was when this class started properly. We kicked off with introduction classes, candlesticks, support and resistance, all of that. I don't know if you guys still remember. For the candlesticks, we talked about the important candlesticks, and then we did the introduction to Forex, where we talked about the different currencies and codes. And I expect that even those people that had exams and probably didn't watch were not available for the live sessions, by now you should have gone through the recordings and you know what the quote currency is. At the same time, you should know what the base currency is. We talked about pips, talked about how to use the MT4 and MT5 platforms, which I anticipate or I expect, not even anticipate, I expect that at this point, everybody on this call or in some point generally should know how to place trades on MT4 and MT5 at the moment. And then we talked about lot sizing, where we talked about using the Nash Market app. And I think another app was provided for those people that use Android phones, since the Nash Markets may not be on the Play Store. So an alternative was provided for you guys for the lot sizing. Then we did cryptocurrency leveraging and all of that. But then I forgot to mention something on that video on cryptocurrency and leveraging. You know, I told you that you can use any stop loss of your choice, provided that you're using the quantity after inputting all of those values. But then whatever leverage you're using, make sure that when you calculate it, like when you multiply it by your stop loss percentage, it does not exceed 100. Let me go to a pair like Solana. This is so USDT. Let's look at something like this now. If I have okay, let's say we're taking, if you look at this, what was happening on this Solana now, this is our typical type B setup that played out here. You can see if we had our sweep of market structure at this level, we had price now putting this point, and then if you had, let's say for people that would have protected their stop loss, they would not be stopped out. But then if your stop loss was very, very close to this, you'd probably be taking out, right? So either way, this is Solana USDT. So let's say you have something just like this, and then you want to use a leverage. Now, if you look at this now, when I tap on this particular thing, if you look at this, it says STOP, that's stop, and then you can see 1.21 in bracket 0.79%. Now that 0.79% is the stop loss percent. If I try to extend the stop loss to this point now, you can see that the stop loss percent is now at 1.84. If I decide to bring it down to this point, it is now at 0.44. If I decide to take it to this point, it is what 0.91. But then all in all, I want to just make sure that you can see what the stop loss percent. Now, what I mean is that whatever leverage you're using, make sure that when you multiply it by your stop loss percent on your setup for cryptocurrency, that it does not exceed 100, right? If you're going to be using high leverages, the moment it exceeds 100, price can liquidate you before it gets to your stop loss. That is why people experience liquidations before price eventually gets to their stop loss. So whatever high leverage you're using or whatever leverage you're using, make sure by the time you multiply it with your stop loss percentage, it does not exceed 100. For something just like this now, let's say you want to use 100x on 0.91%. So you say 100 times what 0.91, you're going to get what 91%, which is still safe to go by, right? 91%. But then let's say in a case scenario whereby this is a 0. Let's say this is a 2.24% stop loss setup now. All right, and then you want to use 100x. 100 times 2.24 is going to give you around 224, which already what exceeds 100. Price will take you out. Like if price will not get saved before you're liquidated, maybe somewhere here now. This is where price will get to and you're liquidated. And then you're taking out before price even hits your stop loss. So whatever leverage you're using in cryptocurrency, just make sure that when you multiply it by the stop loss percentage given to you on your setup, it does not what exceed 100. Once it does not exceed 100, then you're sure that you can use any leverage and you will lose more than you want to lose. All right. So back to what I was saying before I remember this. Now we also treated how to place trades on Bybit, right? We talked about stacking on synthetics, position sizing on synthetics. We talked about candlesticks confirmation. We talked about support and resistance, then market structure, right? Market structure. I think at this point, most of you shouldn't be having issues with market structure. So that is like a beginning thing. Where we talk about the three types of market structure: down, up, and then what's ranging market structure, right? You see that these things that were once complex when this class started are things that you are now getting used to, and that's how it is. That's how everything is. Before you know, these are things that you easily recognize on the chart. They no longer look as cumbersome as they initially did when you started learning. All right. Now, if you look at this now, this is what the downtrend and what the uptrend, and then we have the third type of market structure, which is the ranging market structure. At least if somebody says this to you now, it is something that you would understand and what be able to participate in, and not just participate. It's something that you can what make money off. Do you understand? That's the essence of knowledge, to be able to speak when others are speaking at the same time, make money off it. All right. And then we talked about supply and demand zones. So we talked about mapping out demand and supply zones. We talked about validations for these demand and supply zones. All right. And then the next one, we talked about liquidity and inducement. So we talked about the forms and types of liquidity, pairing, targets, and all of that. But then I missed out something on that liquidity and inducement, which is what engineered liquidity. Engineered liquidity, right? And then the next one, we talked about imbalances, how imbalances are fueled, how you can use imbalances to your favor, because we talked about imbalances being what price magnets. So having the understanding that okay, there's an imbalance right below your entry gives you, or sorry, above your entry in the case of a buy setup, and below your entry in the case of a sell setup, gives you the assurance that what price is going to be attracted towards that entry, and then making it what one of our validations for our for our setups, right? And then the next one, we talked about some of the PDRs, the mitigation blocks, the breakout blocks, the order blocks, and then we also did a small thing on flip zones. But if you remember, I told you guys that flip zones, they're not they don't have a good probability for you to rely on them steadily. All right, there are things that maybe with a very good engagement you can consider probably when they turn to our type A or type B type of setup, but then they are not what you should focus on in today's market, because they have what a lower probability of playing out. All right. And then the next one, we talked about entry models, weak entries, confirmation entries. I also talked about for confirmation entries, pattern and candlestick confirmation. Then I think one important thing that I've not talked about is the TPO. Now the TPO is going to come. This TPO means time price opportunity. it's just like a branch of order flow and footprints. It's going to come in one of our weekly sessions after executions are started properly, right? Then I'm going to introduce this TPO. This is because I don't want it to contrast with those of you that are trying to get the model right already, right? It's an added confluence, not a strategy. So in a case whereby I don't want it to be that, okay, you have your analysis and that is like contrasting. I don't know if you get what I mean, but then the TPO will come in one of our weekly sessions during the course of this mentorship. Okay, now for engineered liquidity, engineered in this case has to be, let me just think of engineered or engineer as create. Do you understand? It took clean POI in technical analysis. You've probably seen people say too clean. All right. Now, a too clean POI is a point of interest. You know, POI, of course, means point of interest, right? So a too clean POI is just a point of interest that lacks inducement. When you have something just like this, and prices retracing to this POI, just like this, no inducement was created prior to this retracement. This is a too clean POI, a POI that lacks what? Every form of inducement. Right? Now, the concept of engineered liquidity is that if price does not see an inducement or a form of liquidity to sweep, it now decides to create one for itself. And that is why you now see, okay, price, there's no inducement before this POI, but then as price is now approaching that POI just like this, it gets very close to the POI, then creates something just like this, more like, oh, starts going up. And then people that were initially looking to buy at this level, they're now like, price has missed entry, or we have missed our entry. And then they start stacking their buys at this level. And what happens? Price goes up a bit and then takes them out and mitigates and buys. Do you understand? So price just creates like a little form of deception just before the entry. It does not break structure. It does not even go for most of the times. It's just like when a POI is too clean, I told you that it means that POI does not have what inducement before it. It lacks every form of inducement. So as price is approaching that POI, what does it do? It just acts like it's a missed entry already. Close to the POI, price acts like it has is already reacting from that level. Now this is going to make people that were looking to buy at this level to want to enter. For those people that are very good at FOMO, that's fear of missing out. They'll not be like, price is still going. Let me just enter market price. Do you understand? And then they start buying. And then price start buying for a while, and eventually what takes them out, takes out all the liquidity we're still there, and does what mitigates and continue. You would find this on gold majorly. This is one of gold's favorite pattern. All right, you find a lot of engineered liquidity in gold. But then for me, I don't like the concept of engineered liquidity. I told you, probably on gold you can have a good win rate with it, but I don't take trades that don't align with my type A and type B setup. That is why the reason why I'm teaching this is because I kept on seeing it on the solution group, people asking what is engineered liquidity, what is engineered liquidity. This is what engineered liquidity is. Price trying to make an inducement for a too clean POI. Now, this may not necessarily have a very good win rate on other currency pairs, but then probably on gold, you can see something okay with it. Okay, sorry, I think my brother has a trade one in here. Let me just use this instead. So probably on gold, you see something with it, but then on other currency pairs, it's not something that you just want to bet on, just like that. All right. Now, good, I can see our type A setup currently playing out. Let me see if this pulled back into 50%. I didn't catch this, by the way, but then I'm surprised nobody else did. This is good on the 4 hours time frame. Of course, there's this was a higher low, a higher high, but then that higher high went ahead to put in a new low, making it what a lower high, then another lower high, another lower low, lower high, and then lower low. And what happens? Price took out the previous lower high, change of character, then went ahead to do what? Break structure again, giving us what? Our typical type A setup, because you can see here we had the supermarket structure. So this is like our type A setup, our price mitigated, and then it's currently buying on gold 1 hour. And even if you go to the 4 hours time frame, you realize that what even the 4 hours time frame, I think even my bro has a buy currently running this the Oanda. If you look at this now on the 4 hours time frame, this is still what? This is still looking bullish. All right, this is still looking bullish on the 4 hours time frame. So until price takes out this low, which is a higher low, before you see that okay, this is what bearish and not valid to buy from. But at the moment, it looks good. All right, but then back to the two clean POI. Let me look for a good example of a two clean point of interest. So I'll go to the 15 minutes time frame. Let's go to the 15 minutes time frame or 30 minutes time frame. All right. Now, if you look at something like let me see. Okay, so this is not hood, but then it's a good example of what I'm talking about. Let's say something like this. You see this movement whereby price, let's say this was a valid demand zone now to buy from. This wasn't because price took out this low, right? But then you see this approach whereby there's no form of inducement before this point of interest. But then as price is retracing to that point of interest, now it gets very close to it and then it starts buying, deceiving people that it's already bullish. And then a lot of people are now looking to buy from it. Do you understand? People now start buying from this level, thinking that, oh, price has missed this point of interest. And then it does what takes them out eventually. That is an example of price engineering liquidity for itself, right? That is how this engineered liquidity works. It's just price creating what? Inducement for a two clean POI. All right, just price creating inducement for a two clean POI. I was trying to go down to the lower time frame to see if I would see a lot more examples. This is gold. I don't usually trade gold like that, just very few times. It's not my favorite pair. So I may not see much of this. But then with time, if I spot more examples, I'll definitely share them with you guys. All right, but then that's what the engineered liquidity concept looks like. Usually caused by two clean POIs, price now creating inducement for itself. Like if you look at what happened there now, that's exactly what happened on this zone. You can see this particular supply level here, where we have this level, and then you can see that there was no prior form of inducement before the level. All right, we had this supply zone at this point, but then price did not create any form of inducement before the level. And as it was retracing, you now go to this point and started selling. More like people that would now be looking to take sell positions from this level, they would be like, oh, price has missed my entry. All right, and then they start looking to take positions from this point. And then it starts that people start loading their positions, and then it starts selling. They believe they're in profit, they're making money. All right, and then what happens? Price eventually comes to take them out and continue. This is a pattern that you would notice mostly on gold. I think it's gold that I've seen the most successful engineered liquidity. But then it is not something that I would assure you that has a very good winning rate. I don't bank on the engineered liquidity as an entry model. For the people at like a star, I told them, except it's like a confirmation pattern. Do you understand? You're doing pattern confirmation. That is when you can use something like that. But if it's a risk entry, I don't like when my inducement. I even usually say to you guys that your inducement level, the best form of inducement is the one that puts in what? Another break of structure, which is a structural liquidity. And the engineered liquidity cannot give you a break of structure. You understand? So it's not something that you can count on all the time. But then it's important that you learn it, and which is what just what treated. Now, I think I have a sell position currently running on this CADJPY. I'm still on it. So let me see if it's this particular broker. All right. So I'm currently on this sell on my pop firm. And then if you look at what happened here, on the 4 hours time frame, first of all, I told you that your first approach towards any of these entries is what the 4 hours time frame. That's how you get your price direction. Now, if you look at this on the 4 hours time frame, the first thing that comes to your mind is price is bearish. After all, price has taken out this this low to put in a new low, right? And after taking out that low, price it went ahead to create what another structural lower high, and then you can see what a lower low at this point, all right? And if you decide to even mark out the structure internally, you notice what if you decide to take out your gun boss, so Fibonacci 2, to map it out from the structural high to the structural low, you'd realize that what this point of interest was what in the first 50%. That's a premium of price leg. All right. Now going down to the 1 hour, since you've established that the 4 hours is what bearish. If you go down to the 1 hour time frame, that was where this POI was spotted. Now the reason why you see me refine like this, I think I've not mentioned this to you guys. But then if you have a point of interest, if you want to map out an order block and you think the order block is too big, all you have to do is take your 50% gambos, map out from what the candlesticks, that's usually is when they are of equal sizes, from up to down, and then let your order block be from what? From this point, which is what? From the 50%. Whenever you see any trader when you see something like this on their POI, I think you should see it a lot on Twitter. A lot of Twitter traders do that a lot, all right? It's just them doing what? Using this 50% to mark out their POI. That's just the essence of what they do. So whenever you see something like this on somebody's chat, just know they're trying to refine the POI to 50%. But this is only when you think that the candlesticks as the order block is too big. All right, that is when you should refine. Now this can lead you to what you become susceptible to missed entries. Do you understand? But at the end of the day, when price fully mitigates the POI, you're safe, but then you miss a lot of entries if you decide to be trading like this, okay? But then it's something that I do. Now back to the POI. If you look at this now, establishing on the 4 hours that this particular pair is what bearish. If you look at what happened here, we had a break of structure. We had this low, this high. Then price did what? Swept structure. That swept this structural high, giving us what? A sweep of liquidity. Now, after the sweep of liquidity, it went ahead to do what? Put in a new low. After putting in that new low, it went ahead to do what again? After putting in this new low, we had a pullback to the upside, which created this lower high that created what? Another lower low. At this point, you now agree with me that this is what? This is like our type A structure. You map out you take your Fibonacci 2, and then you pull from this low to this high to ensure that the inducement leg pulls into 50%. And you can see that at this point now, this inducement level is what? Inside the 50% of the Fibonacci. Let me change this Fibonacci to red so that it's not the same color with the rectangle box. I think this is better now. And then you map out from 50% of what? From the low to the high to make sure that your inducement pulls back into what? 50% leg. And in this case, you can see that what he actually pulled back into 50%. You have your sweep, your break of structure, your second break of structure, inducement intact, imbalance intact, everything in line with the trend. You've actually confirmed it again with what? The 4 hours time frame. What is here? All you need to do is what? To brutally execute. You go to the 4 hours time frame here now. You realize that this is still in the premium of price leg. This was the previous lower high, and this is the new lower low in price leg. All right, if you map it out like this, you realize that this is still what in the premium of price leg. And I told you, when you have a setup as valid as this, all you need to do is to execute brutally, no matter how it ends up, win or lose, so long as all your validations has been met, right? You execute what brutally. This is how this set. This is just the only thing that I traded today. I'm still on the trade. I don't know why it's consolidating around my take profit targets. But if I decide to still check some other pairs, you'd find out that realize that you still have more of these entries playing out. They are recognizable. Like I was looking at what happened on EUR/USD. Now, if you look at EUR/USD now, just looking at it on this time frame, you realize that whatever is happening, EU has been bullish for the month. This has been registering super buys. You can see this. If you look very closely, you notice our type B market structure, our type B entry model here now on the 4 hours time frame. All right, and then you can see that price continued in a bullish manner, creating series of lower highs, higher lows and higher highs, higher lows and higher highs. Now we have this previous higher low and this previous higher high. All right, and then if you map out your Fibonacci from the 50%, now going down to the 1 hour first before you go down to the 1 hour time frame. On the 1 hour time frame, if you look at what's happening here, we actually have our type B market structure playing out here. All right, you had a sweep of market structure, price created the engagement before breaking structure and then pulled back here and continued and even came back to give a pattern confirmation. This is what's happened in today's price action today on EUR/USD. All right, and even if you go to the 4 hours time frame, whatever you're doing is still in line with what is happening on the 4 hours time frame. On the 4 hours time frame, this is what you have. This is the previous higher low at this point, and this is the higher high. You'd realize that whatever you're doing is still is still in the first 50% of price rate. When you do setups like this, all you have to do is to brutally execute. I think I mapped out something. I don't know on which pair. There was one of you that reached out to me that was talking about the guy that I sent something to on WhatsApp. I can't remember him. I mapped out something where I talked about if you don't have the strength to be part of a trend, it is very okay to just ride continuations on that trend instead. All right. If you cannot be part of the people that establish a trend, just ride continuations. If you look at something like this now, this is GBP USD. But then I made an illustration here. Now, if you look at what's happening here, first of all, you would recognize that this is an uptrend. Here we have price creating series of higher lows and higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. Now, at this point, you have established that this is an uptrend. There's no debate. So long as a change of character has not been created, this is an uptrend. But then internally, look at what is happening internally now. You have a sweep, a break, an inducement, another break of structure, and then price pulls back. You understand? So you can decide to find these entry models in already established trends. Price is already bullish, and then you're looking out for these entry models to continue bullish. It's not like you're catching the one that changes a trend, like price is coming bearish just like this, and then you're trying to catch the change of character, all right, which can still do something like this, okay? Not like you're trying to catch this one. Instead, you're catching continuations in between these higher highs and higher lows, higher highs and higher lows. You can decide to do something like this. If that is what makes you profitable, fine. But just make sure that all of your validations at every point is met. That's the most important thing. I tell you for sure, not just for me, for other people that have thought, this is how they are consistently profitable. All right, this is how they're consistently profitable. You see, this CAD/JPY was not even my trade idea. It was Nelson's trade idea, and it's currently on the trade. The CAD/JPY and the gold, I think those are the two buys that he dropped on Sunday. Today is Monday, and there was currently, I think the gold was Friday morning, and then the CAD/JPY was today. And they're currently playing out. They're currently playing out. These are things that have consistently worked for other people. So there's no reason why it shouldn't work for you. At least if it's too bad, a 60% win rate if you're doing it very right. If you're doing your things right, you should have at least a 60% win rate. It's not 50-50. It's not 50-50, depending on the pairs that you trade. All right. So this is enough for you. And it's not even over because we're still going to apply more things as time goes on. But then I need to see results already. Look at the chart every morning. When you wake up, like for me, I woke up this morning. I literally just got to the state that I school in this evening. This morning when I woke up, before I started arranging my things for my flights, what did I do? I opened my iPad. I saw that, okay, this guy dropped a trade idea. I went to my iPad and then I checked out the trade idea on TradingView. And then I did what? I executed. It's that easy. That is just one pair. If you decide to go to all of the currency pairs on your watch list, I'm telling you that there's no way you do that for 5 days in a week and you don't see something valid to trade. It doesn't happen often. And even if it happens, you can't go 2 weeks without seeing one trade idea. The worst that can be is probably that you missed it. Do you understand? Or you can't go 2 weeks without seeing something that you can trade or you would have traded. You understand? So it's enough reasons for you to be patient enough to allow these things to play out. I don't want to see when people send something to the group and then people are able to correct you that, oh, it's in a downtrend. It means that you know, because at this point, I assume that everybody on this call understand what trends. You know what a downtrend looks like and what an uptrend looks like. So if somebody corrects you, it means that you know that this is an uptrend, but when you decide to force the sell, or you understand that this is in a downtrend and you decide to force the buy, in the long run, this will not keep you profitable. To be very honest with you, I'm telling you, as somebody that has counter traded and I still do counter trade, right? Sometimes I'm telling you that if you're starting, this can mess up your psychology too bad. A lot of you will not be able to chase 6 losses in a row. So don't put yourself in that position whereby you start doubting what you know. All right? Don't put yourself in that position whereby you start doubting what you know. The moment you start having issues psychologically, your technicals may not be able to save you. Because sometimes you enter a trade and you're like, oh, let me close. Let me close. It's already $200. Let me close before it reverses. You understand? Your psychological issues start coming in between you and your technical analysis, which is not good at all, because most times you may not even get out of it easily. All right. And then for the for what do they call it? I think I also want to touch on a lot on dairy. Now you understand that unlike the TradingView, that when you have TradingView Premium, you can just have your alerts sent to you to your email, right? On this thing, on synthetics is very different. I already told you guys that the synthetic market is quite like a mimic of whatever is happening on the currencies, and that's the cryptocurrencies and the forex currencies. All right, they don't have their own trading view. They have their own trading view, sorry, but then on their website, that's charts.deriv.com. Okay, so they have their own calculations, their own lot size and difference. You can't calculate your lot size on the Nash Market app for synthetics. You actually can't. And so the same thing for the alerts. You can't set your alerts there. You have to use a different app. Now there's an app called the Forex Alerts, Forex Alert and Crypto Alert. When you go to App Store, I think we should also be available for what do they call it, for Android users on Play Store. So just search Forex, I think Forex Alerts. When you search Forex Alerts and Crypto Alerts, all right, you see this particular app here, the first one here, that is what I'm talking about. Now here's how to use it. When you open it, this is what the first page looks like. You have price alerts, you have indicator alerts, all right. Now for the price alert, that's where your interest lies. You see this place that says VIX 10. Okay, when you tap on it, you can use any pair of your choice. Or when you go to the plus button by my upper right corner, when you tap on it, you choose what the market, all of the markets, you can set the alerts here. Whether it's the XNES, the ICM, the binary com, that's the Binary.com is your berry broker. You have your crypto Binance broker, the crypto, any other crypto currency exchange. You have the Forex, any other Forex broker. That's when you choose this order. All right. So when you go to the deriv now, you can choose any pair of your choice. You can see all of the booms are here, all of the crash are here, all of the jump are here, all of the step indices, the multi-step, the VIX, that's the volatilities, all of them are here. 90, 15 years, 30 years, even the new ones that we added are here. The range breaks, or every single thing that you can think of is here. All right. No matter the markets that you trade, even if it's cryptocurrency market now, when you go to crypto Binance, you're going to see what all of your crypto pairs here. Right? You can see all of your crypto pairs here, your 1000 bonds, your this, your that, your AVE USDT, AVE ETH, AVE BTC, every single thing is here. You can see your ADA USD perpetual, the normal ADA USDT, ADA USDC, all of your crypto pairs are here. So whether synthetics, whether cryptocurrency, whether Forex currency, whatever, everything can be found here. You can see your stock exchanges here as well. All right, you have stock here, and when you go to Forex as well, you can see you can see gold, silver, this and that. So even your Forex currencies too, they are also here. Okay, all you have to do now, when price, you choose the broker, you choose the pair. Let's say in this case now you want to trade volatility 100. You choose 100S, and then you do what? You come here, and then you place what? Okay, when 100S gets below 609, notify me. All right, and then you can choose the custom sound that you want. They have different sounds. I don't think you guys should be able to hear any of them, but when you open it yourself, you can choose the one that you think will wake you up according to how loud you want it to be. They have different sounds, right? And then when you come here, you say, okay, when with 100x gets over whatever price, you put it there. Okay, so here now that says under, you can put it at your entry level or your POI level, and here that says over, you can put as what your take profit level or whatever. Okay, whatever level you want to set an alert on, you do that there. And then you can even have the alert being repeated every 30 seconds, every 1 minute, every 2 minutes, until how long you think it will take you to recognize that you have an alert. And when you're done, you click on what add. Okay, I didn't set any of this thing, so that's why. But then when you click on add, note, let me say 100S triggered. Okay, and then 100S TP add. Okay, and then you realize that the alert is what? Yeah, just like this. This is exactly how it looks like. And when price gets to that point, you'll be notified. I think this costs like 6,000 in Naira a month. So it's just like around $3, I guess. And it's good. With something like this now, you may not necessarily need to subscribe your trading view for alert purposes, except you're doing the whole cutting price. That's backtesting with it. That's the only reason why you should be using trading view premium. If not, this covers for both currencies, synthetic indices, Forex, and cryptocurrencies, and all of the markets, even the stock and all of that, the normal indices, etc. All right, so that's it on how to use this particular app. I told you that it costs 6,000 Naira to subscribe it per month. All right, now I want you guys to also, in the course of your studying, I want you to pay attention to, what do they call this now? I need you to pay attention to trends. There are pairs that do better when buying, and there are pairs that do better when selling. If you look at something like gold, most of your buys, we have better probabilities of holding. Some pairs do better when selling. Like if you look at 250X now on volatility indices, you realize that that's like a gold mine over there. All right, when it's time to sell, it just sells. Okay, if you look at something like the 10-10, that's the 10 and the 10 years, realize that they do well with buys. These are not things that people would necessarily tell you just like that, but they are things that they are patterns that you notice yourself and apply it to your trading. Do you understand? And you need to be that when you're studying, you're not just studying type A, type B. Look at what happens on this pair. Do you understand? Do like it, whether top down, down top, or whatever. Look at what happens. Check out how many times your buy is held, how many times you sell held, right? You realize that there's always one trend that is what's stronger. Okay, for most of the pairs, it can be what the sells. That when it's time to sell, they sell heavily. When it's time to buy, they buy what's heavily, depending on whatever the pair is. Those times it's like more conviction. Like on God now, if you have a buy that meets your analysis, you won't be scared to execute because you know how well buys do over there. All right. Some other players as well. When it's time to sell and you have a sell that meets your analysis, you won't be scared because you know what how sales do well over there. So I need you guys to also tweak this. Excuse me, sorry. I need you guys to tweak these important things into your trading strategy. Do you understand? These are things that would definitely act as a confluence when you're seeing a setup that you're confused about. All right. So this is just like a round-up section. On Wednesday, we're going to meet again by 9 p.m. I want us to talk about prop firms and then probably some other things maybe. This is like almost the end of the class, but then we're meeting again on Wednesday by 9 p.m. to talk about prop firms. Now, remember that this is a new trading week. Today is Monday. Tomorrow is Tuesday, meaning that the trading week has opened. There were some trading setups that presented itself today. There will be more tomorrow. There will be more next tomorrow. There will be more the day after, and even on Friday. I want you guys to be open on the chat, active, very much active. Look out for these things. I told you, you don't even have to catch the exhaustion of price. You understand? The moment you decide to change character, you can just catch continuations, like I showed you in that chart, in that chart example. Right? You can just catch continuations, those in betweens. These things work everywhere. There's a sell currently going on Solana USDT. I think on BTC too, there was a buy, continuous buy. I saw like 3 chains of buy on BTC. This is something that works consistently. But then you have to tweak it in a way that it works for you too. Don't compromise on any of your validations when you're looking for a setup. Don't compromise on anything. It is better that you don't see a trade setup than you intentionally catch a wrong one. Trust me, not trading is also a part of your trading strategy. At the end of the day, as much as your goal is to make money, your goal is also to not lose what you already have. You don't want to lose money unnecessarily here. So I'm still pleading, all of your validations must be met. Everything, don't compromise on anyone. If you have to send the setup to the group, if you look at the winning trades on the winning trades subtopic, you would see that these people that are dropping those setups, go through all of them. Sometimes I just go there, I go through the winning trades, the losing trades, and I think the trade ideas and the question subtopic almost every day. If you go through those winning trades, especially, you realize that those people, those setups are looking that neat because all of their criteria were met, whether synthetics, whether currencies, whether Forex or cryptocurrencies, whatever. Make sure that you don't compromise on any of your validations. I wish you guys a very happy trading week. Okay. I'll see you guys again 9 p.m. on Wednesday. Stan, please, you can end the recording. Thank you so much.